In today's video, I'll be talking about 6 mistakes beginner investors usually make. I can almost guarantee that the viewers watching this right now are be guilty of or are currently guilty of one of these 6 investing mistakes. If you are new to this channel, my name is Elias and I make videos on personal finance, investing and business. Stick with me and make sure to watch to the end of the video. Hopefully, you're able to avoid these mistakes entirely and save yourself a bunch of money in the process. And let's get right into it. The first investment mistake that can be avoided is paying too much in fees. One of the traditional thoughts when it comes to investing is simply just park your money with a financial advisor who will just invest it in mutual funds for you. Mutual funds are essentially portfolio of stocks and bonds that are professionally managed. As a result of having professional management or active management, as they say, as a result, their expense ratio fees are rather high. Let me give you an idea on how much in fees they could charge you. According to Morningstar, the average large cap funds with assets greater than $5 million has an expense ratio of 1.45%. Now compare that with a Vanguard index fund like VTSAX, which tracks the S&P 500. The expense ratio on that is 0.04%. VTSAX, as it is known, offers you the ability to buy that fund, and all of a sudden you get a piece of everything that it owns in the fund itself. It's also passively managed and also has a lot of diversification built into it because it's investing in a total stock market. But what's the impact of having a 0.04% expense ratio versus a 1.4 or 1.45 expense ratio? In this example, comparing VTSAX to a large cap mutual fund such as Riders Nasdaq 100 fund. If you are to invest $10,000 for 20 years and the fund returns remain the same, it will result in a net difference of $11,000 just in fees. How crazy is that? So whenever you're looking at something to invest in, especially if it's a mutual fund or an index fund, always pay attention to the expense ratio and make sure it's as low as it can be. Another common mistake that beginner investors make is trying to time the market. There might be a bit of anxiety feeling when you're trying to figure out whether to enter the market or not. And honestly, the best time to enter the market is immediately. Everybody wants to get into the market when it's at the low point, but nobody really knows the low point until after it has passed. It's really tempting to pick the market highs and the market lows so that your portfolio can never go down in value. But truly, that's not realistic. When you're trying to wait for a dip in the markets to buy, the problem is that 99.99% of people that are waiting for the market to dip ends up just waiting and waiting and waiting, and then all of a sudden the market keeps climbing and climbing. Now they get impatient and then they buy. When in reality, if they are just bought earlier, they will have been way better off. What happens at the end is that these people end up buying at the very top of the market and they get really panicked when it goes down a little bit. And what they do is that they buy high and they sell low, which is never what you should do. But really, the whole buy low, sell high is very stupid. Just buy immediately because being in the market beats timing the market. The best strategy, I believe, is to buy long-term investment and hold them for a very long time so as to save yourself the headache. The third investment mistake beginners make is not investing at all. The thing is that many people are scared to invest because they are uncertain about investing and they don't want to lose what they already have. While there are ups and downs in the market and in the short term, you could lose money. The problem is if you don't invest at all, you are still going to be losing to what is called inflation. The inflation target set by the Fed is 2% every year. So if you leave your money in the bank now, you're actually going to be losing out to inflation. So what should you do to combat this? You can at least put your money into something that is at least beating inflation, which could be by investing or owning assets. Another mistake beginners make is not considering tax implications. What some beginner investors don't know is that stocks are actually subject to taxation. Taxation depends on the stock, how much you've earned on the stock, and how long you've actually held it for. You pay income tax on any dividends or interest payments and capital tax gains on the actual share price of the stock itself that you hold and if it goes up. If you hold investments like stocks for the long term, such as longer than a year, you actually qualify for what's called long-term capital gains rates, and those rates are slightly less than short-term capital gains rates. So if you're investing, make sure that you're investing for the long term because that will save you some money in taxes. But if you want to avoid taxes altogether, what you can do is open up a tax-free retirement account like a Roth IRA. So whenever you're investing in something, always make sure you know of its tax implications. Number five is letting other people influence your investing decisions. Chances is if you get into investing, a lot of people would have some sort of investment opinion for you. And the majority of bad investment advice come from people to people who just want to get rich quickly. If you can avoid the pitfall of trying to get rich overnight, you are going to do a whole lot better for yourself. And all that it just takes is investing consistently over a long period of time. Number six is kind of a two partner. Number one is not knowing how much to invest in, and number two is not knowing what goals to invest in. What you want to do when you start investing is to figure out the goal that you want to do with your investing. That way you can kind of reverse engineer an investing strategy that actually works for the goal that you have for yourself. So if your goal is to retire early, or maybe your goal is for just capital preservation, or if you want to be liquid in cash to make a big purchase in the next few years, for example like a home, each of the investing strategy that will be used will definitely differ because of the different goals. So I think a lot of beginners can benefit from the question. So I think a lot of beginners can benefit from asking themselves the question, what is it that I want to get out of investing, and then work back from there. I hope you learned something from this video and learn from some of the common mistakes that beginner investors usually makes. For more videos, make sure you hit that subscribe button, hit that like button, and turn on your notification bell so you'll be notified when I drop my next video. See you guys in the next one.